But today, some excitement started. J.P. Morgan and Goldman Sachs kicked off earnings season. J.P. Morgan's boring, and we don't recommend them, so who cares? Goldman Sachs, though, however, knocked it out of the park yet again. Would you like to talk about the, Vampire Squid? Who started that? When did that happen?
I don't know.
I quote it because it is funny and it's true. But anyway. They knocked it out of the park. A couple of divisions had record quarterly revenue. They had record first half earnings for the year. We've talked about this a lot in the past, especially you, Frank. The environment of volatility, uncertainty, and really nobody else or nowhere else to go but here in the markets is huge game for them.
I mean, real quick to answer your point here is, listen, you have the perfect environment. You have government injecting trillions of dollars into the system. It's not yet fully thrown through the system. More trillions are coming for infrastructure. You got super low interest rates, so more people are borrowing. It's very easy to raise money. You have M&A activity near all-time highs, and you have incredible. NASDAQ just came out with their option contracts just under their record from March. I mean, when you have that kind of volatility and you have those perfect conditions, that's one of the reasons why I recommended Goldman Sachs a year ago and doing fantastic on it. And I keep saying it's going to get used to these results of them blowing it out. Like people say, well, investment banking, they can't really, forecast for it. It's going to be massive. They're going to be blowing out earnings. I'm just surprised that they're not raising it. Yeah, this is when they say they beat by $5.17, and they reported earnings of $15. They're supposed to report earnings like $9.80, whatever it is. So they beat by over $5. But who are the analysts that cover this? Like, that big of a beat. You got to expect, like, hey, these guys are used to generating 25% returns on their investment bank. I mean, who are the guys in charge? Because that's the 985 is a consensus estimate, probably of 25-30 sell side analysts covering Goldman. I mean, we pretty much knew they were going to blow it out the last 3-4 quarters, but yet they keep coming out with these numbers that are so conservative where it's kind of funny. But they're increasing their dividend by 60%. They beat in almost every division, but
that's huge. I mean, the dividend is huge, and especially in this environment and going forward, because we're always going to be talking about interest rates and what happens there. But big dividend payers, I gotta admit, I've been surprised and wrong on how yields haven't come down on huge dividend companies. Like, I still can't believe that tobacco stocks pay 5 to 7%. I still can't believe AT&T pays a huge dividend. But I'm okay to wait and continue to look at those. We'll get into tobacco maybe, but investment banking led by a huge backlog, so future orders coming down the pipe. And can we get into the Battle of the Grills real quick?
Yeah, go ahead.
Because one of those, do you have that article up? Because one of the, who is it, Frank? Weber, and who's the other one?
I forgot the other, but it's two of the leading grill
Traeger,
people, right?
Is it Traeger?
Yeah. They're both going public, yeah. Just awesome.
And Goldman Sachs is leading Weber, and I think it's Morgan Stanley leading the other one. And there was a hilarious Zero Hedge, who I'm a big fan of, as you guys all know, had a good article about the Battle of Wall Street and the Battle of the Grills. And I'm pulling a blank here. I'm trying to find the article that I had saved here to bring up for you.
So here it is. All right. So we got...
And what stood out to me is Weber was profitable in 2019 and 2020, but had an enormous jump up because a lot of people were locked down, stayed home, bought grills. Have you seen the demand for backyard pools?
Oh, yeah.
I have an amazing friend in contact in Arizona who does pools in backyards.
Oh, it's insane.
Business is just booming. I can't wait to catch up with him this week. But Weber was profitable in 2019, increased it in 2020, but the other one had a huge loss in 2019. Do you see that paragraph? Do you have those numbers in front of you?
I have the numbers. So it's Traeger Grills, right? So TGPX, plans to list on New York Stock Exchange under the ticker, you guessed it, Cook, C-O-O-K. And then you have Weber Grills. I think Weber between $4 and $6 billion. Yeah, this is pretty cool. I mean, it is. It's just a big battle. But Morgan Stanley, right? So you have Goldman doing the Weber listing and Morgan Stanley doing the Traeger listing. So
these are good fees. And do you think you get like steaks and invited to cookouts as part of this? Or
I don't think it's even worth it for these guys. They make so much money. I mean, they probably own the steakhouse. It's just why even bother with the free steaks or whatever? But it's just the amount of stuff that these guys are able to get. And also, Weber's offering, being led by Goldman, but also Bank of America, JP Morgan.
Oh, yeah, everybody's there.
And just, you look at these revenues, man. Traeger reported revenue of $545 million. Net income of $31 million in 2020. Weber reported almost $1 billion in sales in the 6 months through March. So, I mean, you're looking at these are like real companies. And okay, if you just go right to your local Lowe's and you're going to see tons of grills outside, but people are buying them like crazy. New houses going up, and people have money to spend. And also don't discount the outdoor effect too, right? Where people just
absolutely
inviting people over. Barbecues are fun. And in a lot of places, not in Florida, you were told that, until July 4th, you weren't allowed to have a barbecue with your family or you're going to die from COVID immediately. Yep. So now it's all opened up. People are like, hey, let's have people over. Let's have fun. We saw the home run derby too. Millions of people there. They're doing interviews without the masks on. It's just nice to see. Very nice to see.
And this is this is the pipeline that Goldman has. So we had some fun with the grills going public and all that, but those are investment banking fees. If this is the great environment where you have a lot of money sloshing around in the system, you still have eager retail investors. I know you were talking about the retail investor and the power that they can enforce and get behind. So this is a win-win situation. Why not go public if you're Weber? You love to see it as a Goldman Sachs group. You're going to close that deal sometime in the next coming quarters or whatever. And so investment banking stays strong. Asset management is huge. And of course, they're just amazing traders. Even though their commodities and fixed income was down 40% year over year. Now, that's a little tricky because year over year comps are comparable sales. You're comparing this time of year during last time. Obviously, with the coronavirus, the lockdowns, the volatility was extreme. So their trading desk and revenues went through the roof on the fixed income side. Even though that's down, say 40% it still came in, I believe, just under $5 billion, give or take.
Yeah.
And these guys are it's a boring story now, but hopefully all the CRA subscribers got into that. And, you can't beat them, so you join them, Frank. That's the morality of investing today.
We're going to talk more about that morality of investing, the way this is going, because you did talk about Goldman Sachs, right? Which is pretty funny. What was that? How much was it last quarter, last year, the comparable?
Yeah, so I was just going through it real quick, and I loved it because they said, so they reported $15. Let's see, where's it at?
Yeah, $15.02 per share.
Okay. So they were talking about in the prior year, this is just from like page 1 of the earnings release. So in the prior year, net provisions for litigation and regulatory proceedings reduced diluted earnings per share by $8.23 for the second quarter of 2020. Obviously, that's when they took the big charge off and all that kind of stuff. But, it goes to your point when you opened up. There's just certain people that get away with certain things. There's rules, and when you're in a situation, and I have family and friends that can't stand the line of work that I do because they think Wall Street's a bunch of crooks. Everybody knows that kind of argument and knows there's a little bit of truth in that. But it's crazy because you don't get to set the rules, but these guys get to, and they also get to jump on both sides of them. So as an investor, you can use that to your advantage. You can avoid it. You don't have to buy it, but it just shows you how there's a set of rules for certain people and everybody else. And this is a way for the quote unquote little guy to at least get a return. So. Yeah.
And those results just driven by, corporate lending, higher net revenue underwriting. And you saw the same thing with JP Morgan, really good results, earnings of $3.78 per share, beat estimates by 69 cents, which I was surprised to see. His revenue fell 8% year over year to $30.5 billion. So sales fell, but again, you have interest rates lower, not as good for these guys, but still they beat estimates. So they brought a decline in revenue. I mean, just to put that in perspective, I think Goldman Sachs grew revenue by like 12-13% or something like that. So investment bank $36 billion. Yeah. So when you're looking at some of the things that stood out to me with JP Morgan, they said the surge of advisory activity continued Q2. That's M&A equity underwriting fees up 9% due to strong IPOs. That continues. But a couple of things. Debit credit card spend was up 45%. And I like what these guys are doing where it's up 45% year over year, but they say up 22% versus the more normal pre-pandemic second quarter, right, of 2019. So it gives you a better comparison of not only it's not just, hey, the stay-at-home stocks benefited tremendously and now they're starting to come down. When you're looking from 2 years ago, now you're seeing that comparison where you're seeing there's a lot of these companies are growing a lot faster and people are spending more money. Earnings are all-time highs, but yet, again, pedal to the metal for the Fed and they keep going. I don't know why. It's another conversation. But expecting accelerated growth across travel and entertainment, originations and home lending up 64% to $40 billion. Auto up 61% to $12 billion, very strong. However, if you're looking at this division, which is the consumer and community bank, the whole division, loans were down 3%, reflecting elevated prepayments in mortgage and lower credit card balances. I found that interesting. What it's telling you is that, not only people household wealth is increasing, and that's probably due to your home price or whatever, but people are paying off their mortgages and people are paying off their loans. They're spending money, right, which it just show, but they're also paying down their debt. But just, when you're looking, I don't know what to make of that. That line kind of just surprised me. Like, JP Morgan's going to make more money the more loans they give out and stuff like that. But the fact that reflecting elevated prepayments and mortgage and lower card balances, I think, that's a good thing for people. It's not a great thing for the market when you want more debt, more spending, right? When people start hoarding their money in savings and start lowering their debt, that's less money in the economy, right? So, but it's good personally. You're lowering your debt. But anyway, I just found that interesting. And we're in a super low interest rate environment. Maybe their mortgage was at a higher interest rate and stuff like that. It made sense to pay it off, refund, whatever they did. But overall, you're looking at results that are absolutely amazing across the board. Any of you that are concerned about the banks, forget it. They're more strong than they've ever been. You've seen the numbers. Even the chargebacks, they made money off of fewer chargebacks. They've never been stronger. The consumer's never been stronger right now. For most people out there, I know there's still people struggling, and that's evident. You're going to see that in the rest of the earnings reports coming out the rest of the week for banks and financials.